What's up, YouTube? Live Econ Guy here. Thanks for tuning in. We are live. In this video, I want to discuss the recent criticism that Dr. Burry, Dr. Michael Burry, from the Big Short. I'm sure most people heard about him, the guy that shorted the stock market. But recently, he received a lot of criticism because he sold basically all of his stock portfolio. With the exception that he invested a tiny percentage, essentially, of his portfolio into some prison mental health stock. And guys, what Dr. Burry is saying is that the recent stock market rally, that it's pretty much a joke. So if you look at the trends, if you look at the S&P 500, the NASDAQ, and the Dow, and you look at around June 15 of 2022, you'll see that before that there was this huge bear market ever since the start of 2022. But after this Federal Reserve meeting in middle of June, what happened was investors just went crazy. And I think one reason for that is that the Federal Reserve increased the federal funds target rate by 75% basis points. And what the markets and the media especially were alluding to is that they were going to increase it by 100 basis points, but they only increased it by 75. So that gave kind of this vibe throughout the markets that the Federal Reserve doesn't really have control and they can't really do as much as they say they will. So they're saying that they're going to combat inflation, and a lot of the media and the even markets are thinking that they're going to increase the funds rate by 100 basis points, and they only increased it by 75. So ever since then, there's just been this rally, essentially over the past 2 months. And what Dr. Burry is alluding to is that this rally is essentially the same kind of what they call the bear trap. So before every single crash collapse, there is this kind of fake rally that happens. And guys, I don't know, I think there is a lot of credibility that could be given to what Dr. Burry is saying. Basically, the Federal Reserve made it clear that they're going to continue to hike interest rates throughout 2022 and probably into 2023, even though they pretty much are almost at neutral, which is around 2 to 2.5% federal funds rate. They're trying to achieve an average neutral. So the federal funds rate has been extremely low over like the past decade. So ever since the great financial crisis of 2008, they just dropped it, and it's been pretty much close to zero for a very long time, with the exception of it being briefly hiked under the Trump administration. So we still had Jerome Powell as the Federal Reserve chairman, and he was briefly hiking it right before the pandemic started. But even before the pandemic started, there was a weakness in the market. So essentially what happened was, let me show you this. So as you can see, guys, between 2016 and kind of 2019, there was this bump in the federal funds rate. So that was a little bit of quantitative tightening. So what happened there was essentially the stock market, not just the market, the credit markets became very volatile. So there was basically no liquidity in the market, even though the funds rate only went up to like 2%, just over 2%, so just over neutral. And they had to stop. They had to start decreasing the interest rates, the federal funds rates, because of all the criticism. Trump was basically calling Jerome Powell an idiot and whatnot, so that didn't work out. And then, on top of all of that, the pandemic started, so there was just this drop to essentially 0%. So now they're trying to hike interest rates back up to achieve an average neutral, which means that, for example, uh, whatever time period that they choose, they want that average federal funds rate to be 2%, from 2 to 2.5%. If you look at this chart that we're looking at here, and you take an average of this, you're going to end up at about 1.68%. So if you were to achieve 2%, and let's say, over the next couple of years, it'll be really interesting, like where the Fed actually takes the funds rate. But I think it'll be a lot of hikes in the coming months. And part of the reason is that it takes a while for these hikes to even have any kind of impact on inflation and unemployment rates. So a lot of these hikes that started in 2022, we didn't really see the impacts of them yet because not enough time has passed. So it takes a while for someone to go out and do some mortgage shopping or whatever, or get an auto loan or apply for any kind of installment loan. So it's not something that's immediate. One thing that is immediate is that your interest rate on your credit cards go up, but that's just one of the things. Normally it'll take like half a year to a year to see the actual impacts. So there's not going to be a scenario where suddenly inflation is much lower, so they're going to stop hiking the interest rates. They're going to keep hiking interest rates because there's not going to be this immediate impact. And as Jerome Powell mentioned in the Fed FOMC meeting, the consumer is still very aggressive. So there's people still buying. Demand is much higher than supply. So yeah, guys. Going back to Dr. Burry, like I said, I do think he has a very good point that there's just so much hype going on right now, and there's not really any kind of economic indicators pointing towards any kind of reason why there would be a rally. Like there's not quantitative easing happening or anything of that nature. I think we're just seeing this what's called a bear trap before, and I think it'll be interesting in the September FOMC meeting when the inflation data comes in. I think it'll still be elevated, and when they raise it by another 75 to 100 basis points, I think that's when people are going to start realizing that the Fed is serious about this stuff, and they're not just using their kind of credible threats and kind of like essentially trying to scare the consumer into spending less. So guys, let me know what you think. I'm going to leave some links to some articles in the video description. Thanks for joining me. Feel free to like my video and post a comment to get the algorithms moving.